Hello, everyone. I take this opportunity to welcome everybody on board who have joined today in this live presentation on mergers and acquisitions from different parts of the world. My name is Umasudan Subramaniam, and I'm very excited to see all of you on board today. And the agenda for us today is mergers and acquisitions and the key risks of mergers and acquisitions. I believe this is a very relevant topic today because if you could see in 2021, the number of mergers and acquisitions and the value of deals that have taken place have increased significantly compared to historical years. We saw a sluggish year for mergers and acquisitions in 2020, and we all know that it was driven by COVID-19 and related incidents. So in 2021, all the central banks around the globe are implementing an expansionary monetary policy. Interest rates are at historical lows, and companies have built up a lot of cash in their balance sheet. So what we are actually looking at is a liquidity induced mergers and acquisitions in 2021. And we expect the trend to go up in the future. But the problem here is that if you really look at the stock market valuations now, most of the stock markets, including S&P 500, Nasdaq, and Nikkei index, most of the stock indices are at historical highs or near historical highs. So this would mean most of the acquisitions and mergers must be taking place at expensive valuations. So that is, again, we all know one of the critical issues in mergers and acquisitions is that they usually happen at an expensive price. So taking that into account, I feel with the increase in M&A activities now, it is very relevant today to talk about the key risks that are in mergers and acquisitions and what are the success factors behind critical success factors behind successful acquisitions in the past, and with some real world examples, and also specifically talk about where things can go wrong based on real world examples. And I definitely would like to make the session highly interactive. So if you have any question during the presentation, if you think that is relevant to that specific point that we are talking about, you can always feel free to ask the question. But also would like to inform you that there's going to be a dedicated Q&A session at the end in the last 15 minutes. We are going to have a dedicated quick Q&A session, so you can even ask questions at that point in time. So since it's a short presentation for about 1 hour and 15 minutes, followed by a 15 minutes Q&A session, I'm going to straight away get into the topic here. I'm going to start sharing my screen now, and then we will take it forward from there. So basically here we are, we are actually going to talk about risks in mergers and acquisitions. So that's going to be the agenda for us today. So I'm going to give you a brief introduction on what mergers and acquisitions are. And before that, we need to know growth strategies are strategic options available for organizations around the globe. To start with, whether to grow or not to grow itself is a strategic choice an organization must take. There are organizations who are smaller but generating superior return on equity, return on assets. They are happy with it. So we cannot really call them unsuccessful because they are successful based on what they want to do. So no growth could be a strategic option as well. And if you want to grow, there are various options available for you, and we can broadly categorize them into internal growth or organic, or or external growth or inorganic growth. So internal growth is all about an organization trying to grow on their own. For example, if a bank is introducing additional branches, ATM machines, that's an example of an organic growth. The benefits of organic growth is that the growth could be incremental, so it's easy to manage them. It's less risky and less expensive. But if you look at external growth, an organization is growing through mergers and acquisitions or joint ventures, or what we also see in the recent past is strategic alliances are on the rise. The problem with these mergers and acquisitions, they are expensive, they are risky, but they offer you an overnight growth. You'll be able to grow quickly compared to your organic growth. So that's all what we need to understand at this point in time. When you move into the next slide, very often people have these questions. So is M&As, we talk about mergers, acquisitions, are they the same thing or is there a difference? Technically, there is a difference between mergers and acquisitions, but in this presentation, when we talk about, we don't really make a big difference between them because most of the issues are very general in nature. Merger is all about when two equally sized organizations merge, get together. You see, for example, here, similar sized organizations, not exactly identically sized, but a little bit similarity in terms of sizes, and they merge together and a new entity created. So what happens in a merger? The existing entities disappear and a new entity gets created. Obviously, it's going to be a larger entity, but in an acquisition, what typically happens is that a larger organization trying to acquire a smaller organization, trying to control them through purchasing their equity shares. So what's going to happen? The both companies are going to operate as they are from a legal standpoint, but the subsidiary is going to be controlled by the parent. So that's how you look at it. And one of the key things to understand in a merger, in the combined entity, the shareholders of both entities are going to have joint ownership. That is what we call a share swap agreement between two entities merging. But when you're talking about an acquisition or a takeover, this is going to be pretty simple in terms of how this happens is because one company is going to buy the stake from another company's shareholders. So other company shareholders are going to fully or partially divest from their investment. So that's how acquisitions happen. So acquisitions are usually simpler in terms of valuation, in terms of legal factors, the regulatory approvals compared to mergers. So going into the next slide, there are different type of mergers and acquisitions. We classify them into primarily three: horizontal, vertical, and conglomerate mergers. I mean, we know horizontal mergers are done to increase the market power or market share and also to capture synergy benefits. So before that, what is horizontal mergers? Two organizations in the same industry or similar industry merge between them. For example, if one bank merging with another, it is a classic example of a horizontal merger. So that is a horizontal mergers there. And then, the objective is synergies. So how synergies get created in the sense, we all know what is synergy. It's like 1 + 1 is greater than 3. So when two organizations jointly operate, there's going to be revenue synergies, cost synergies, and operational synergies. And each of them is going to have access to their respective resources, technology. So that is where the horizontal merger is coming into the picture. When you talk about vertical, this is going to be, slightly different. It's basically in a vertical synergy, you can divide them into vertical forward and vertical backward integration. Vertical forward integration is basically a company trying to acquire a customer like petroleum organization trying to buy service stations is a classic example, or a vertical backward integration. Let's say a milk powder manufacturer acquiring a dairy farm is an example of a vertical backward integration. Again, the objective is getting synergies and having a complete control over the supply chain. So that's pretty much what we are talking about here in terms of vertical and horizontal organizations. The primary objective is strategic fit and synergies. Conglomerate mergers, on the other hand, there is an interesting question from Narayan. I'm going to take that up after explaining what is conglomerate diversification. A conglomerate diversification is an organization trying to diversify into different business lines, not necessarily into one single segment, but into different business lines. So that is, where there is little or no synergies could be present there. So there's a good question here, Naveen. Thank you for asking this very relevant question at this point in time. Can you explain diversified acquisitions where there is no or little synergy? I would put it this way, when you are trying to manage your portfolio of your investments in your organization, you are adding a new business line, you need to really look at the correlation between your existing portfolio of companies and the new company that you are adding. I mean, whether it is going to have a negative correlation, positive correlation, or zero correlation, or near zero correlation. So I would definitely think it depends on what is the overall correlation between the business units that you have and how they are related to your overall portfolio. If your objective is not synergy, if your objective is risk mitigation, then I would think you need to get into companies, diversify them into different business units who have negative to low correlations between them. So then you're going to have, you're not going to have a control over supply chain, or you're not going to have a significant amount of power in one single industry, but overall your risk is going to be minimized. So end of the day, it depends on what you would want to really do in terms of this. But although, there is from an academic standpoint, there is research to claim that there is no benefit for conglomerate diversification for companies. If you go back into academic literature, specifically into capital asset pricing model, I think everybody must be familiar with, the CAPM model to determine cost of equity. So that model, if you really go back, we assume that, investors completely diversify unsystematic risk, company specific risk, because the investors, they are actually going to diversify, completely, they're going to diversify their own portfolio by having a diversified portfolio. So there is no benefit for companies trying to diversify. That is just a theory, but I know there are so many organizations, as you pointed out. HEMAs are actually pretty successful. Just to give some local examples from Sri Lanka, HEMAs, JKH, Aiken Spence, quite diversified portfolio. So I would definitely call them that they are successful. So that's anyway, great question. Thank you for that. Moving into the next slide, we are going into what is a successful acquisition. I think I would definitely put these acquisitions, actually 6 key things behind successful acquisitions. Number one, you should be able to identify the winners very fast when they are at an infant stage. So this is very important. We are going to look at examples to say how companies have been successful when they try to enter into markets at a very early stage and acquire infant companies. We call them bargain hunting. Access to technologies, resources, and skills. That is another reason. Industry consolidation, definitely I want to talk about that. I mean, this is very important. I think if you really look at in the recent past, the number of acquisitions and mergers taking place for these reasons have increased quite dramatically. what happens is due to the technological innovations, significant number of traditional business units are being challenged. And one such example we can talk about is paper and forest industry. What's been happening to these paper manufacturers in the Europe is that they have been they have been heavily impacted due to electronic media development and people moving digital. So what has been happening is that there has been excess supply into this sector, and demand is on the free fall. So what companies have been doing in this sector is closing capacity to reduce supply in line with demand so that you can maintain pricing power for these paper manufacturers or any other declining industries. So this is again another interesting area because if smaller entities are adding capacity, disrupting the demand supply balance and creating a negative impact for the pricing power of the industry, what large players do is they acquire companies, kill them, they acquire smaller organizations and close them down because they want to reduce supply, they want to bring in market discipline because they want to regain profitability by increasing the pricing power. So that's the third reason. Moving into performance improvement, we also see a lot of acquisitions happening these days uh, to restructure organizations who are bleeding money, maybe with COVID-19. So there's plenty of opportunities available for large organizations to acquire underperforming companies for cheap valuation because they are underperforming but with good potential, so the companies can easily turn around. And then this is a common reason to increase size, become an economies of scale, become kind of rather a dominant firm, a oligopoly, or a large organization to have a cost advantage relating to that. So that's another reason. And the last one is quite interesting, and I'm going to talk about more on that in the coming slides. Removing potential threats. If you really look at in the technology sector in the recent past, many acquisitions have been happening to remove any potential threats. That's one of the key things emerging in the technology sector at the moment, and we are going to look at some examples. Okay, this is an interesting slide. You could see, identifying the winners early is the most important thing that you need to understand. So, and then if you really look at Google bought a startup company, Android, in 2005 for just as $50 million. And everybody knows about Google and Android, and how they became successful as a result of the acquisition. And then Google acquired YouTube in 2006 for as low as 1.65 billion, but the estimated market value of YouTube now is $170 billion. So that's something to think about. And Alphabet, the Google's parent, has a market capitalization of about $1.6 trillion, of which 170 billion is estimated to be the value of YouTube. So you could see identifying those hidden gems and finding the right partner is very important in M&A space. So this is an interesting one. Disney and Pixar merged in 2006. Disney is an entertainment company, and Pixar was more into computer animation. So when they merged in 2006, the PE ratio of Pixar, which the shareholders of Disney had to pay, was 84 times. That kind of considered to be a very expensive acquisition over there. So that's a very expensive acquisition. But then it is proven to be successful now because they were able to create a success story. We could say it's an expensive merger, turned out to be a success story as Disney was able to leverage on Pixar's computer animations. So, I mean, we don't completely agree when you say all the mergers and acquisitions are expensive. It might seem to be an expensive for somebody, but if you really got a strategic reason, if you really got a strategic value behind such acquisitions, they can look expensive at one point in time, might not be expensive in the long run. So that's something to look at. There was a question earlier on airline companies. I think definitely 2021 and 2022 merger wave is probably on companies which are severely impacted on mergers and acquisitions. So one such example is airlines. I think definitely there are quite a lot of opportunities for companies with large liquidity buffers to buy smaller airlines. That's been happening already in the UK, in Europe, and in the US. Some companies are of course going bust, some airlines, but some are being acquired by larger organizations. So this is probably a good bargain hunting opportunity. But at the end of the day, the valuations at which the deals happen is something that needs to be taken into account, specifically because I don't really consider the airline industry is going to have a temporary setback. Obviously it is a temporary setback at one angle, but if you really look at it, there is a structural slowdown that might happen with people getting used to digital conferences and digital meetings. The demand for business travel could potentially come down. This is, I'm not talking about 2 3 years. If it is just 2 3 years, and I wouldn't really make it a big impact on the valuations of airline companies, but because there's going to be a structural reason for people shifting to online channels in the longer run, and potentially can have an impact on these airline companies' valuations. So going into the next slide, an interesting slide. Many acquisitions around the globe have actually happened to potentially eliminating threats. So these are the four good examples we could think of. Facebook bought Instagram for $1 billion in 2012 to prevent Twitter or Google acquiring Instagram. Number one. And they went on, and bought WhatsApp. WhatsApp was loss making at that time in 2014 when Facebook bought them for a thumping $22 billion. A lot of people criticized the valuation, but I think the price was fair in terms of the potential synergies that these acquisitions could create. And then Google paid close to about $1 billion to buy Google Maps, the ex-competitor Waze. It's now owned by Google. So that's again another example for buying a competitor who you think is a potential threat for you. And then Uber bought Middle Eastern competitor Careem for 3.1 billion in 2020. All these acquisitions are done to eliminate potential threats, and they have been proven to be successful. One good example, if you want to really think about it, Yahoo. Yahoo is becoming another Nokia in because what happened in 1998, not just one, not so long ago, in just 1998 and 2002, they have been offered to buy Google for a very low price, but both the times the Yahoo executives turned down the offers, and you see the value of Google now. See, this potentially means that you should be very clever not to miss out any potential attractive or attractive opportunities. There is an element of luck, I agree, but there is a greater insight, or if your leaders are visionary, if your leaders are able to think beyond numbers, it's a very good opportunity to look into these acquisitions beyond numbers. Right, so looking into the next slide, mergers and acquisition waves. This is a very interesting thing to understand. First of all, what is the M&A wave? I mean, it is not a very new terminology for us because we've been hearing so many waves, isn't it? I mean, with COVID-19, there's like a lot of waves we are talking about. So, what is a mergers and acquisition wave? It's like a period of time, a specific period of time in which there has been a massive increase in the number of deals as well as the value of deal, compared to a usual period. So that period is designated as a M&A wave. So what happens is that during that period of time, you see significantly higher number of M&A deals compared to a usual period, right? So each wave is actually driven by a specific factor. Now we could see this wave, the fourth wave, and ignoring first, second, and third wave due to lack of data, and they become not so relevant for discussion now. If you look at fourth wave, it is actually ended in 1990, so it was a 10-year period from 1980 to 90, and what dominated during that wave is hostile, a lot of hostile takeovers, and corporate raiders trying to control over other entities. So that was driving there. And fifth wave, that was between 1993 and year 2000, was all about cross-border mergers and acquisitions, where companies understood the need for geographically diversify their businesses. So, what prevailed during this time is cross-border acquisition. And if you really look at 2001 to 2008, that's pretty much like the acquisitions were induced by cheap finance. The banks were lavish and they were lending enough money, and we know that this is a period even when the subprime loans increased and then eventually became a bubble burst in 2008-9. So this is the period where there was cheap credit available for companies, and M&A activities were driven by that. And now the current wave that we are in is the seventh wave, and it's probably the longest because the wave started in 2010 and still ongoing. And in this seventh wave, and we see significant number of technological innovations, M&A activities to do with technological innovations, emerging markets deals, and consolidation related deals, as we spoke earlier. And if you specifically look at 2020, there has been a drop in M&A activities. 2020, there has been an M&A activities in the seventh wave. So basically, so in the seventh wave, last year was sluggish, but if you look at it, 2021, there has been a significant pickup on the deal values for the first 4 months. The data is only available until April. There has been a significant increase. Total number of deals in 2021 accounts for approximately $17 billion. So, and we estimate, that to be, basically going to go up, and we would expect that to be close to the levels seen in 2015. So we know the reason. It's a liquidity induced merger and acquisitions, because we are living in a low interest rate environment. Companies have piled up a lot of cash. So there's a lot of opportunities for M&A activities in 2021 and 2022. We expect this to continue. So the seventh wave to get more, expanded into the future. Okay, that's a good question. Financial mergers, induced mergers influenced by the regulator. Good for financial service institution in Sri Lanka that happens in the financial sector consolidation process. Definitely, a country like Sri Lanka, I would definitely think the number of banks that we have is way too much. So time to time, we have actually seen this happening in Vietnam, where regulators induce and they actually mandate certain mergers and acquisitions. I think for the banking industry to survive in the long run, it is good to merge them, because, in terms of maintaining your interest margins, in terms of managing your asset quality, your regulatory ratios, it's not, and especially the tax regime in Sri Lanka, if you look at historically, have not been really supportive towards banks. So I would definitely think, not just like Sri Lanka, most of the countries where there are too many banks for a small population needs consolidation. So I definitely welcome what the regulator is doing there, proposing banks to merge. And I definitely welcome these ideas. Although that's my personal view. So moving on to this global M&A activities, we are actually talking about global M&A activities by waves. We see the seventh wave has the highest number of value and volume. You could see massive number of 37,759 billion worth of mergers and acquisitions that have happened in the seventh wave alone. And you could see on an annual basis in the seventh wave, the number of M&A deals have surpassed 46,000 compared to 36,000 in the sixth wave, 26,000 in the fifth wave. So seventh wave is so far the longest and heaviest in terms of value and volume. Okay, there's a question from Shamant Khan. Thank you for asking that question. We are talking about cheap, toxic finance driven M&A could be back due to cheap funds available, especially in the loan markets. Definitely I agree with you. Due to there is cheap funding available, there is a significant M&A deals are happening due to cheap funding available. I don't personally think it is a great thing to do because you do mergers and acquisition just because the interest rates are low or you have good cash or you have credit lines available. So these acquisitions in the past have not really helped to, it probably helped, the investment banks and others to make large amount of fees. So it could help, short-term benefits for companies. But I think in the long run, if you try to do things like that without a strategic purpose or a strategic fit, just because you've got cash and you cannot keep them, you want to do something about it, those acquisitions. I think I'm personally against such acquisitions from SECA. Thank you for that question. Okay, this is this is a slide. If you want to later go through the waves and what was driving each stage of the waves, you can potentially look at them. And what is very important for us to see in the last couple of waves. What we are seeing is in sixth wave, fifth wave, fourth wave, fifth, sixth, and seventh waves, where mergers and acquisitions were driven by various things. If you look at it in the fourth wave, it was driven by hostile takeovers. Fifth wave, cross-border M&A. Sixth wave, M&A driven by cheap finance. And seventh wave, where we are currently in, is actually driven by technological innovation, consolidation needs for companies, and it is also driven by significant amount of need for restructuring in the current space. So moving into the key topics for us today, key risks in M&As, or as we know as per academic literature, almost 70 to 80% of the M&A deals fail. And so we need to understand what reasons behind that. We know about success stories. We spoke about Google and YouTube. We spoke about Disney and Pixar. So we spoke about quite a lot of examples of successful mergers, but there are a lot more failures, and there are so many unheard failures. There are so many heard failures, but the most important thing to understand what were behind such failures and learn from that knowledge to feed into the future. So that's what is the most important thing to look at. So the key risks in mergers and acquisitions. So moving into the next slide, I think this is a very important slide to understand. An organization, when they want to merge, they need to compare two specific things. Number one, net realizable synergies from the acquisitions. Synergies could come in terms of revenue synergies because there could be cross-selling opportunities between one entity and another entity. Cost savings in terms of centralizing operations, laying off people can offer you significant opportunities in that space. and large number of operational synergies as well on that space. And then that's you need to understand that how do we value synergies is quite difficult. One, we need to identify the annual synergies and forecast them into the infinity. We call them terminal value, and discount them to arrive at the present value. So arriving at the present value of these synergies is probably the most difficult things to do, right? And we believe the synergies are very often overestimated at the time of an M&A deal. And so we need to always compare these net realizable synergies with the acquisition purchase premium. So what is acquisition purchase premium? This is basically when companies pay above the market value to purchase companies. So how much they pay over and above the market values is what we call acquisition purchase premium. So for a merger to be value accretive, create significant value to the shareholders, the net realizable synergies must be greater than the acquisition purchase premium. So this is a very important thing to remember. But very often, net realizable synergies are overstated, acquisition purchase premiums are understated, and as a result, leading to value destructive M&A deals. So how do we say APP is understated? It is understated because we always calculate this as a percentage above the market value. By the time when you look at the market value, people already know about the merger. So the market value, the base market value which companies use to calculate the APP is always biased. So meaning that the APP is significantly higher than what you actually look at it, because already the price of your target company have increased because people already know about it in the market. If you really look at an efficient market, mergers are very much known in the market even before they are announced. So the APP calculation, I think you need to review them when people say they're paying over and about 20%, which is reasonable. Probably they are paying more than 20%. So it makes sense for you to go and look at the last couple of years how the target company share has been growing to understand what is a realistic APP should have been based on an average price rather than just looking at a specific point which could be biased because the information already presented into the share price. So it's a very interesting slide to look at. Okay, then this next point where mergers go wrong is because of wrong timing. It's very important that you do M&A at the right time in a wave. We spoke about waves, merger waves. We could actually classify these waves into 4 stages. Stage 1, 2, 3, and 4. Stage 1 and 2 are very early stages in a merger, and 3 and 4 are mature or later stages in the merger. So I think the right time in terms of timing to buy a merger or do an M&A deal is probably at the beginning of second stage, or at the first and second stage are probably the best, because during this time there are funding issues and there are lack of management confidence. So the valuations tend to be reasonable in the first and second wave of a merger wave, right? And companies with sound liquidity and deep pockets could leverage on this opportunity during the first and second wave. And historically, if you look at it, there is evidence that M&A deals happen during first and second wave, proven to be more successful than the other one. So the wrong timing, you do the merger and acquisition in the third and fourth wave, where we say that during third and fourth wave, your acquisition purchase premium tends to be above 100%. So you almost double the amount of money, the market price to buy an acquisition. So you're setting failure from the day one. If you pay more than the required premium that you need to pay, you are setting the failure for the first day itself. So that is something that you need to look at. Historically, acquisition purchase premium is just 38% of your over the cycle, over the cycle acquisition purchase premium is just 38%. So high failure rates are observed in a merger wave when acquisitions happen in the third and fourth wave because the acquisition purchase premiums usually exceed your net realizable synergies. Okay, we also need to understand the motivations behind many people, many stakeholders push for M&A deals in mainly related to third and fourth wave. So all such motivations are not in the best interest of the shareholder. So this is something that we need to look at. During the third and fourth wave, banks increase their risk appetites and lend lavishly. Acquirers fear missing the sweet spot. Everybody wants to be a Google, or everybody wants to be a Facebook or a Disney. So everybody wants to, want to jump into conclusions and try to do something, try to act too smart, but end up in big misery. So that's something very important. Your compulsiveness should not, drive you, but instead you need to make well-informed decisions. Lack of available targets and overconfident management team further increase the valuations. And the last point is, something very important to understand. The M&A advisors and investment banks probably push for mergers and acquisitions because that could potentially lead to higher M&A advisory fees for them. So companies also need to be very careful about this. So if you pay more, the acquisitions turn out to be the winner's curse. Something to look at, the right timing and the wrong timing. So that's something very important. So there are valuation issues which you need to understand. If you overpay an acquisition, you're going to have a large amount of goodwill in your balance sheet. A large amount of goodwill, it would mean that you have paid significantly above the net asset value of your subsidiaries. So if your post-acquisition synergies do not materialize, or if they are not enough, subsidiaries starting to make losses, that can potentially lead to goodwill write-off in the future. So this is an important consideration or an accounting issue that must be looked at carefully. And other estimation issues, and most of the issues are estimation of synergies. You have poor visibility on revenue synergies. I think the only synergy which you could reasonably estimate is the cost synergies. But what is very difficult to model, what I have personally seen happening in M&A deals, is the estimation of the revenue synergies because of the poor visibility there. And because synergies play an important role in your valuation and what you pay, a poor interpretation or a poor estimation of synergies can often lead to wrong valuation of companies. And the earnings multiples such as PE becomes very difficult to interpret if synergies are not properly estimated. And there are post M&A expenses that you need to look at. You estimate integration expenses, and there is usually a cost overrun which can potentially increase the price that you paid after the acquisition and leading to failure. And there are other valuation issues relating to estimating the discount rates, that you need to discount your free cash flow to the equity back to the present value. There are various ways to do this. If you are especially acquiring companies in a different sector, or you are acquiring private company, then you would have to use pure play method, unlever the beta, then relever the beta to get your cost of equity as a discount rate to value to discount your present value. And I think this is also an area where there is potentially some gaming happens if the board of directors or somebody want to really push for these acquisitions, or some deal makers want to push for this acquisition. This is particularly when these guys can play around and make an unattractive valuation look attractive. There is a question, can estimated synergies be affected due to cultural issues? I think that's the next slide that we are going to talk about. I think once before the other slides, I will take it up at that point in time. Integration issues, yes, you are right, plays a major role. We will talk about it in detail. The mode of payment affect the valuation. When I say mode of payment, how the acquisition is being funded or how the shareholders of each companies are being settled. Cash or share exchange, share swaps are the general mode of payment. They affect the valuation. Acquisitions funded by the debt. I can give you some examples later in a couple of more slides to come. Acquisitions funded by external debt bear higher risk in uncertain times. So that is something that you need to look at. So the mode of payment affects the valuation. That needs to be understood. There are corporate governance issues. I think this is an area which is increasing in popularity. A lot of people now talk about ESG, environmental, social, and governance factors. That is becoming a major factor in screening companies for investors and portfolio managers looking at ESG factors, because investors want to invest in companies which have got positive ESG factors, who contribute positively to the environment, who got good social and corporate governance practices. That is applicable here today because most of the mergers and acquisitions do not happen in the best interest of the shareholders. Directors want to diversify their own portfolio and push for mergers. And directors are motivated to push certain deals to increase the firm's dependence on the management. And M&A deals leverage on market irrationality and undervalued target firms without a strategic fit. And I think I relate this point to one of the questions previously being asked. Cheap financing could actually induce this type of corporate governance issues. You buy companies just because they are undervalued without any strategic focus. So that is something that you need to take into account. And acquisitions are also motivated to increase short-term earnings without any long-term focus. And we also want to look at some of the accounting issues here. Determining the fair value of assets is not always straightforward. And sometimes you need to be careful about the negative goodwill. Negative goodwill means that a company trying to acquire another company for a cheaper value, lower than the net asset value of that company. Potentially, we could call it as a bargain purchase, leading to a negative goodwill and a positive earnings surprise in the acquirer's consolidated financial statement. I would definitely want to review these calculations before we take them seriously, because there is always a motivation to increase the fair value of the target firms to report normal earnings in the P&L. So that is an accounting issue that comes in. I'm not trying to say all your negative goodwill is incorrect, but this is something that you need to pay more attention before you take any insights from it. So that is something to look at. And then we are moving into the next slide, where we are going to talk about other issues in mergers and acquisitions. I think this is a question raised before. There are integration issues that I pretty much don't really talk about other issues much, simply because they are so overrated. If you talk to everybody, why do mergers and acquisitions fail? Because a lot of people say due to cultural differences, leadership styles, other incompatibilities, a lot of integration issues. Both companies do not work together because of different leadership style, different culture, different language, different systems, different resources. So obviously, that's a key factor. But what I see in the last wave, these cultural differences and leadership styles are actually, to a larger extent, companies have overcome this issue by, having a multicultural leadership team in place and bringing in external consultants to advise them on M&A deals, and having a multicultural board, multicultural management team help you to avoid some of these integration issues. I'm not saying it's not a major issue, it is still a major issue in M&A success rates, but it is overrated, and the valuation issues are kind of an underrated issue on your M&A failure. Execution risk, we say the experience of your senior management team in conducting acquisitions is something important that you need to look at. And takeover defense strategies, this is very important. What is a takeover defense? If you are actually talking about hostile takeovers. So, what do you mean by hostile takeovers? These are takeovers which happens, without the concurrence, without the consent of the management or board of directors of a particular organization. The board may reject an offer, but always there is a possibility that the acquiring companies can pursue shareholders directly those acquisitions are called hostile takeover. One great example, there's always a controversy on Facebook's acquisition of Instagram in 2012, which is kind of a hostile acquisition. And then so what companies do to prevent these hostile takeovers? They do takeover defenses. And some of these takeover defenses, they are not in the best interest of the shareholders. But we need to agree that they are needed in some cases to prevent hostile takeovers. And some of the examples are poison pills, golden parachutes, white knights. There are so many other. There are about, I think, 70 to 20 takeover defenses you could consider if you don't want to be taken over by a potential hostile predator. Right, and then the regulatory requirements in some industries like banking, insurance are, a lot. It takes a lot of time to finalize a merger or an acquisition. By that time, the valuation changes. So, end of the day, we have seen so many good mergers and acquisitions have been dropped out because of the regulatory delays. Right, so now we're going to look at practical examples relating to overestimated synergies. We could look at some examples to understand what induced this failure in these mergers and acquisitions. Haynes and Kraft merger in acquisition in 2015. Haynes acquired Kraft. Both are food processing companies for $55 million, and the EV to EBITDA at which it took place was 23 times. So what happened here is that the parent entity focused too much on cost control. They achieved success in cost control, but they lacked customer focus, innovation, and now there is a lot of shift towards more healthy and organic produce. But I think that is one area Haynes and Kraft completely neglected. So this tells you how overestimating your revenue synergies and an overly focus on cost cutting and cost and operational restructuring could actually mask some of the key problems behind. You would feel you're saving significant amount of cost because that is what you will visualize in the first couple of years, but you don't really realize that you are not focusing on innovation, customer preferences, and you have simply overstated the revenue synergies on that angle. So that is something important learning from the past. Let's look at one more thing. This is the Bayer's acquisition of Monsanto. Bayer is a global healthcare company. They acquired Monsanto, which is into an agrochemical company. So they acquired the company for 18.6 times EV/EBITDA multiple. So what happened? The acquisition was primarily funded by debt. But subsequent to the acquisition, there was a lawsuit on Monsanto, and which they failed because the lawsuits alleging Monsanto's Roundup weed killer caused cancer, and they lost the lawsuit and paid 11 billion in damages. And this led to loss of reputation, and this deal was a failure simply because not just these unexpected events, but unexpected events coupled with very high level of financial leverage put you into a liquidity crisis. So this is exactly happened with this M&A deal. So if you need to really understand the contingent liabilities in the balance sheets, which are not reflected in the balance sheet of your target company. So understanding their contingent liabilities, that is where the due diligence process becomes extremely important. And in risky acquisitions, if you fund through debt, you're further increasing the risk out there. So this is something that you need to pay attention to. Are you funding through debt or equity? What is the level of business risk and the financial risk in your acquisitions? So that is something to look at. So the topic here is that unexpected events, debt burden, and opportunity cost. So moving into something very interesting, I think everybody would like to hear this part of the presentation. The technology-driven acquisitions of the five tech companies. They are Amazon, Microsoft, Alphabet, and Facebook, and Facebook and Facebook and these five Apple. No, I missed out Apple. So these five companies, sometimes we call big four and sometimes we call big five in the technology industries. They have grown through mergers and acquisitions, not just into their own business lines, but they have also grown outside their business lines significantly over the last couple of decades or so, phenomenally, and now they are too big, they control all of us. Not just they control industries, not just they control the economies, they control, people lives. If you look at, acquisition of Facebook, acquisition of WhatsApp by Facebook, Instagram. Now they are all connected, creating a lot of privacy issues. So there is a lot of antitrust probe against these companies. That is something important to look at. This is the story about Apple. So what's happening is that the strong industry players in the industry continue to buy small startup companies to strengthen their position. So what usually happens is that regulators tend to overlook at them. They don't really look at them as anti-competitive because these acquisitions are insignificant. So they tend to ignore them. But if you really look at them collectively, you see the amount of market power these guys have gained over the years. So we call them copy, acquire, and kill practices. And recently, not just recently, for some time now, these tech companies are being investigated for having excessive power, having done hostile takeovers, and creating an anti-competitive marketplace. So if you look at Apple, since they incorporated, they have done 96 acquisitions into new business lines and new sectors, and 27 acquisitions only in their own business line. Something important to look at. So if you move further down into the next slide, you see, one second, please. You look at here, they're talking about Google and Amazon. I think Google is the guy who has done huge number of acquisitions. They have done 187 acquisitions just in 2 decades, and 81 in their own sector and 187 in the new sectors, creating a single monopoly in this particular area. And then Amazon, you see 71 acquisitions in new sectors and 40 in their existing sector. And similarly, Facebook, 77 in the new sectors and 28 in their existing sectors. So what's actually happening here is that these companies are acquiring large number of businesses, mainly small businesses, when they are infants. They buy them, copy the technology, and kill them. And that has been the practice over the last couple of decades, creating a monopoly for these large tech companies, which is being investigated. I think this type of acquisition will continue to dominate the M&A space in and at least until the end of seventh wave. Right, so now this is a very interesting slide. I think I'm going to talk about some concluding remarks on the future M&A trends. These are just my personal opinion. What I would actually expect to see in the next couple of years on the M&A space. And so once we are done with this, we can actually open up for Q&A session. And so, based on what we discussed now, we could see that we are in the seventh wave. It is the longest merger wave that we have seen in the history, and still it is growing steadily. And we know there was a setback in M&A activities in 2020, but companies have the mergers and acquisitions have rebounded in 2021 with excess liquidity available in the market. So large cash pile up in the balance sheet of large companies and lower interest rates are driving liquidity-induced mergers and acquisitions, which I see a key driver in the next couple of years. But the tricky part here is the valuations. As I previously mentioned, most of the stock markets are historical highs. This is something that we don't really understand, because with COVID-19, economic fundamentals of many countries got deteriorated. We see unemployment rates were very high sometime before, and inflation goes extremely low and in some cases negative. And then central banks around the globe and together with the government came up with lax policy measures to improve the economy. So that is why we see low interest rates, and we see unemployment rate going down in the United States and elsewhere. So there is some recovery and hope with vaccination programs, and not definitely in all the countries. I know some of the Asian countries are still, battling against the second and third waves of COVID-19. But definitely, I would want to think about positively. 2021 is going to be a year of vaccination, hope, and recovery. Although the recovery is going to be slow. But what we don't personally understand, what I don't personally understand, is that the markets are at all-time high. So we are seeing the economy is bottoming out, and recovering. Inflation growing up as people trying to spend. Especially, I see wage push inflation happening in major markets like Australia and in the United States, of course, because of immense amount of labor shortages in certain industries due to lockdown and people going back to their home countries or home cities. There is a shortage of people. That's driving inflation. So, I mean, that's a good news. Economy is reviving in those countries, and that would slowly translate into Asian economies as well. But the important thing to look at is that in this time is that these stock markets and the economies, they don't really go in tandem. The correlation, there is a correlation breakdown. We have seen when the economies do well, stock markets go up, and the economies go down, the stock markets come down. But we see a correlation breakdown. Economies are not so doing well, but the stock markets are at all-time high, thanks to those stimulus and big relaxed policies of the governments and the central banks around the globe. So there's a lot of funds shifted to stock market because of low interest rates. People moved money into the stock markets, and that is driving the stock prices up. So this is something that you need to look into it. So if you do any merger and acquisition deal at this point in time, it can potentially be very expensive given the increase in the market price. So when you're negotiating an acquisition purchase premium, I think this needs to be taken into account because already the prices are inflated and you're going to pay a premium on top of it. That's just not making sense to me. Okay, there is something I think this I see as a threat for M&A activities, which is IPOs. There's a strong pipeline of IPOs in developed markets and also in some emerging markets. We see a pickup in IPO activities. So this is an alternative for investors who want to divest and take their money out. So they actually, go for IPOs instead of doing expensive merger and acquisition deals. So by listing your shares to the public, you dilute your stake, but you are able to cash out some investment. So you can see some of the examples that I can talk about is DoorDash. When they came up with this IPO, the stock price closed 86% up in the first trading day from the IPO price. And Airbnb, we all know about the company. This is where we used to go and stay when you want to do a European holiday or so. They offer, cheap accommodation. Where if you are a customer, a member of Airbnb, you could go and list your apartment on rent. So this company have done an IPO, and on the first day, the stock price climbed 112%. So there's a lot of IPO activity, strong growth of IPOs. I think this is a threat for the alternative for companies, shareholders looking to divest. They do it through IPOs rather than trying to find out an acquiring company to sell the company to them. And then I also think market consolidation and restructuring deals to streamline businesses in order to cater to the slowing growth. This is going to dominate the M&A space in the next couple of years for sure. There is a lot of needs to consolidate into airline sector, in the banking sector, in the telco. There needs to be a lot of consolidation that needs to take place in the next couple of years, aftermath of COVID-19 effects, and definitely the digitization and the transformation of business activities. It is going to be a strategic priority for us because M&A is the quick way of transforming your business, digitalizing your business. We see a lot of banks in the United States are trying to acquire small fintech startups, either to develop them or to buy them and close it down, just to ensure that the financial institutions are not significantly disrupted by the technological innovations like fintech firms. So I expect to see large banks, either they go fully digital, they close down. We already see so many banks, global banks, are closing down their branches, closing down their ATM machines because they are going completely digital. They are focusing more on innovations and internet banking and various advanced technologies that is on the other side, they're also getting into fintech space by acquiring smaller banks so that they can potentially prevent threats of fintech companies disintermediating banks from the banking from the financial intermediary space. So this is again something that I look forward to see in the next couple of years. And then ESG factors, this is becoming the style now. Everybody start to talk about ESG factors. I don't know, for fun or for real, but I think this is a holistic concept. If you want to look at it, ESG means environmental, social, and governance. So there are so many screening companies around the globe who does screening on companies and assign scores for various companies and publish a list of companies who got positive ESG scores, negative ESG scores, and I actually think ESG becomes an integral part of the valuation of companies. It needs to be taken into account. Companies with positive ESG should be given a premium into their valuation, and negative ESG companies should be penalized. So ESG aspect of companies will drive your valuation in the future. There are bargain hunting opportunities in most impacted businesses during the COVID-19, such as airlines and FMCG, classic examples of where there are selected opportunities available. And next point is something that I would like to pay some attention here on the due diligence process of M&A deals needs to be more robust than ever before. And why I say that is that, if you are negotiating an M&A deal now, you need to, always what we do is we look at the last year financial statements. Last year financial statement is going to be your basis to look at anything, your P&L, your balance sheet, your free cash flows, whatever you look at it is 2020, but we know 2020 is abnormal now with COVID-19. So with COVID-19 2020 numbers, so we don't have a base number to work with. We don't know the baseline EBITDA, baseline earnings, baseline free cash flows. So that is a difficult thing. I think you should first normalize earnings. There are various options. Some companies are simply going with 2019, but I wouldn't really say it is right, because 2019 for some companies is very outdated. So the challenge is to look at your 2019, 2018, and 2020 numbers, try to normalize them to come up with a normalized EBITDA, normalized free cash flows. That's going to be your starting figure in building your forecast. If you make any mistakes there, that mistake is going to drive into your complete valuation model. I think a strong financial due diligence should help to fix that issue. That is something very, very important point to look at. So moving into the next point, the bottom line, what you need to understand, although we say overpaying companies has been a major issue in the past. We know about that. Expensive acquisitions are bad, they are value destructive, but you need to understand that in some cases, overpaying is not really overpaying. If the acquirer has a clear vision, clear strategy, and clear value creation plan for the future, and the timing is just right, you are not jumping the gun. So this is something very important to understand. And then I also expect this antitrust and regulatory scrutiny on big tech firms and anti-competitive practices would continue. I think, this would continue. These companies, they are not going to stop doing this. I expect these activities to moderately slow down, but it cannot stop. This is how these companies have grown, and that is how they will continue to grow. So that's pretty much from me. I think I'm right on time. We got about 15 minutes for the Q&A sessions. I open up for Q&A sessions now. If you have any questions to talk about. So I basically open up for questions. So there is a question here: how Disney was sure about 84p as Pixar is in a movie business, which may or may not be a success. I mean, I would definitely think, it is the ability of your business leaders, your board, to foresee and predict market trends. Probably they realized that as an entertainment company diversified into many sectors, Disney thought what is lacking or what is missing there is a computer animation. So that synergy worked well. So it's all about, you try to see, like, try to look beyond the numbers and see how adding this particular ability or technological feature, having access to that, how is that going to improve your competitive advantage? This is beyond numbers. I'm definitely thinking, 84 times PE is a joke, isn't it? If you talk about 84 times PE, we are not happy. The US market trading about 20 times PE. So think about 84 times PE. So, I mean, companies who have done this, they have done this very accurately because they know this is beyond numbers, this is going to work because that synergy is just great. So I think that is the missing piece in so many mergers and acquisitions. You need to have a senior leader who is visionary, could see things beyond logic, could see things beyond numbers. So that's something very important to look at. So thank you, Prasanna, as always, for your. I'm very privileged that you participate in this session today. Thank you for that, and thank you, Naren. So I'm very pleased that you are able to take part in this presentation, and thank you, Mohammed Rausan, for your participation as well. So we could take more questions. We got about 10 more minutes, so I can take a couple of questions if anybody want to talk about it. Right, that's a very good question here. What external factors would you consider when acquiring an entity dealing with cryptocurrencies in operations? So the biggest challenge in the valuation of cryptocurrencies is that you cannot use a free cash flow based valuation because these currencies do not have any cash flows relating to them. So there is no rationale for valuation. So that makes the valuation of cryptocurrencies very tricky. It is a speculation driven thing, and so many kind of regulatory factors affecting the development of this. So I think what is going to be, and people said initially it is a digital currency and it is a competition for dollar or euro, but in the day it's proven incorrect because large cryptocurrencies such as bitcoins experience a normal level of volatilities where we cannot accept them as digital currencies. They are not recently China has said they are not going to accept cryptocurrencies as a payment alternative. So what's actually going to happen is that there is very little rationale to value cryptocurrencies because there's so many things are uncertain, and so many countries are not even, their regulatory environment is not even prepared to accept cryptocurrency trading or something like that. So when you are acquiring a cryptocurrency organization, you are already into cryptocurrencies. I think it is merely by the popularity or activities of investors rather than a logical valuation approach from an academic point. I won't be able to suggest anything to you, but that's a very relevant question. Now everybody start to think, okay, how do we value crypto? So how do we value crypto companies? So that's a good question. Thank you, Vinuri. You have been a usual participant of my training programs. Thank you for attending today. And thank you, Mr. Ponnaperma, for your participation. And thank you, Siva Roshan. I hope you will continue to participate in the sessions in the future. All right, now it's a good question from Venkata. Is that may know what valuation methods are popular in value companies for acquisitions. I would definitely think it is industry specific. Now, the valuation multiples that we use for valuing different industries are actually different. If you look at telco industry, for example, we use EV to EBITDA. Why do we use EV to EBITDA? EV is the enterprise value, which includes the market capitalization of the company and the market value of the debt. And then EBITDA, we know is a popular measure, earnings before interest, tax, depreciation, and amortization. And why EBITDA for telecom companies is because telecom companies have high depreciation. They have large capex investment. So when large capex investment turn out to be large depreciation and poor earnings, so EBITDA is a measure, and these companies in the telecom sector are highly leveraged. So their interest expense tends to be lower, tends to be very high. So the right KPI is EBITDA, which measures the operating performance of the telco business. So when you talk about EV to EBITDA, yeah, it offers the great, great insights into companies' valuations. And any other highly capex capitalized industries, we would use EV to EBITDA. But we are talking about banking sector. At least what I have seen is that most of the banking sector valuation takes place based on price to book value, because you have, all the assets of the banks are on the balance sheet. But if you look at technology space, as we discussed previously, works on cash flows. So you use a mixed approach of, discounted cash flows, EV, EBITDA, price to earnings, price to book for banking sector. And I could also tell you, if you are a diversified company, each segment should be valued differently. Like some of the parts valuation methods could be more useful there. So it's definitely, I think, going to be mixed. Right, so there's a question from Shafi. So Shafi, I hope you're doing well. So there are more M&A deals failing and investment banks pushing for M&A deals for high obtaining fees. Isn't it the time there is an international regulator to set standards similar to International Accounting Standard Board? Yes, that's probably a great idea to do. I mean, the only thing that I can tell you is, Shafi, for international accounting standards, it was very easy to do that. But I think for M&A space, building a common regulator is a great idea from you. But I think it is going to be very difficult. And the last thing that I want to see is good mergers and acquisitions failing to happen, or they are being over scrutinized. And there are some acquisitions which can help the society, which can help shareholders, which can help everybody. So I just don't want those companies to fail, or those acquisitions to become much more bureaucratic just because of regulators. So it's a great initiative. Definitely the regulators need to take into account, but I think it is going to be a difficult task to come up with a regulator for a great thought, a point to ponder for all of us. Thank you, Randy, Taranga. Thank you for your participation as well. And thank you, Divakar, for your time as well. Thank you. I look forward to seeing all of you in forthcoming webinars as well. The question from a feedback from person. I appreciate if you can touch on different valuation techniques that could be used for various industries and the reason logic for applying those with some examples in a future presentation. Yeah, I think that is, I mean, I think you are reading my mind. There was a question on explaining about different valuation. I start talking about EV, EBITDA, and talking about PE, some of the parts method of valuation. So definitely, I think that is a different topic on its own. We need a full session, an hour and a half, to talk about different valuation methods and why they are used, how they are used, like telecom EBITDA, banking sector price to go, establish a matrix so that can be very well helpful, not just for companies to value for M&A deals, but even for people looking at stock market investments or equity analysts out there. That can be a helpful addition into my future webinars, and definitely take that into account. Prasanna, thank you so much for your participation. And I think we are close to the finishing time of presentation, and I take this opportunity to thank all of you despite your family time on a Sunday, and in the Middle East it's a working day, and it's a family time for the rest of the world. So despite all that, I like your enthusiasm or interest in developing your capabilities or insights into attending these webinars, so which is greatly appreciated. And I know some of you guys are actually holding greater positions in organizations, and definitely your participation always makes these events highly interactive and helps the co-participants as well. So thank you so much, all of you, for attending today, and I look forward to seeing you in a forthcoming webinar session, probably on evaluation of companies, something in that scope. And thank you so much for all of you joining today. So we are almost at the end of the time. And so I'm going to just finish off the session now. Thank you so much once again. And I hope to see you soon.